on our radar. The bookings have been much better than what we've seen in the last few quarters, and the company has seen a fourth quarter of positive cash flows as well. The one thing that has worked really well for DLF is their deleveraging plan. The debt has reduced further. Ashok Tyagi, the whole-time director for DLF, joins us now to talk about that. Mr. Tyagi, good morning and thanks so much for joining us. Before I ask you about DLF, I wanted to know what's happening with the luxury residential market itself. Is there a slowdown underway that we're seeing across the country and specifically in NCR as well?
So, good morning, Sonia. You know, honestly, one reads and hears a lot about this slowdown of the luxury segment. Frankly, for us, the situation has, in some sense, been the reverse. Because actually now, if you see for the last 4 to 5 quarters, a significant component of our sales came from two products. One was Crest, which was in the price range of 5 to 8 crores. And the second was Camellias, which was in the price range north of 25 crores. Honestly, Camellias continues to sell at a reasonable clip of whatever, 6 to 7 Camellias a quarter. So I think the issue is that while overall there might be a slowdown on the luxury space, I think if you have a unique product from a locational standpoint, which is complete and has a perceived value, I think you still would have the market for that. But yes, you are right. From whatever one reads about the macro industry, luxury is facing some struggle, especially in Mumbai and other cities. But for us, luxury has delivered pretty well in the last 4 to 5 quarters.
Okay, well, that's good to hear. Good morning, Mr. Tyagi. How are inventory levels at this point in time? Is that also showing some signs of ebbing?
So our inventory levels, Lataji, were about 11,000 crores as of March end. We had given a guidance of about 25 to 2,700 crores of sales for this year. So we expect that our inventory levels as we exit this year should be about 8,500 crores, which if the current traction continues, I mean, in all fairness, in a 3-year cycle should get liquidated. Our first quarter sales, as we reported, were just north of 700 crores. So I mean, we were on the run rate that we had guided the market for, slightly ahead of that. And honestly, whatever little we have seen of Q2, about half of Q2 is gone, we seem to be adhering to that run rate. Obviously, one reads about all this, the slowdown in some of the other consumption spaces in the economy, and frankly, at least so far, it hasn't impacted us. But we'll obviously keep a very close watch to the ground of how these things impact us going forward.
Biscuits, Mr. Tyagi. I'm not able to get over that news item, so it's difficult to believe that any part of the market is not affected by slowdown, especially because real estate has been in a bit of a glut for some time now. What about receivables?
So our receivables, Lata, are by and large on track. I mean, we have had no significant increase in delinquencies for now almost 4 quarters, and I'll be completely transparent with you. There are some historical slow-moving receivables which continue to be, slow-moving, but for a large chunk of whatever we have been selling, we have been collecting on schedule. I mean, there could be a couple of weeks here and there, but generally all these schedules have been there. Most of the people who had taken bank loans, and a large chunk of our customers do take bank loans, have been delivering on time. An overwhelming proportion of our sales in the last 9 months has actually been under the down payment scheme, where customers get a significant down payment rebate, and they actually pay the complete piece in a 180 days time cycle. And frankly, that is the reason why, despite the challenges in the overall financial system, a large part of our receivables have been quote-unquote protected, because the customers actually were paying for them upfront. In fact, it's also the higher proportion of the down payment rebates, the down payment payments done by the customers, which have led to a consistently positive operating cash flow over the last 3 to 4 quarters that you would be seeing.
Okay, I completely take your point, Mr. Tyagi, that you are, of course, DLF is, doing much better at a time when the entire industry perhaps is facing challenges, but I'm sure you understand that there is this big liquidity crisis that is underway. I mean, there are a whole host of incomplete projects for the industry that continue to reel under this liquidity crisis. So how is the situation on the ground? I mean, you told us about your own situation that, there's no constraint and luxury market is picking up. But for the rest of the industry, do you think that things have gotten worse?
So, if you look at the rest of the industry, I mean, I think as we have maintained earlier also, today in each geography, I think the industry can broadly be split into two segments. One is the 3 or 4 players who have sort of, fixed their balance sheets, fixed their operating cash flows, and are either sitting on inventory or sitting on reasonably advanced projects and are in a reasonable position. However, I would add a caveat that every one of those, including us, are at sales levels which are nowhere near what the full potential of those sales levels would have been had the market been completely normal. However, in each geography, you also have a large, I'm sorry to say, multitude of smaller and medium developers who are saddled with half-finished or unfinished inventories, with significant cash flow crunches, in a large number of cases with lots of litigation, some of which are with the Honorable Supreme Court now as well. And frankly, how that resolves will have a bearing on the overall market as well. I mean, honestly, nothing that's happened in the last 4 quarters portends to a positivity on that front, except for one particular project which the Supreme Court has awarded the NBCC to complete. So, I mean, that will be interesting to see how that pans out and whether that could be an operating model for some of these stressed developers. But yes, the numbers vary, but say of the broadly 1.5 lakh plus unfinished inventory in the NCR region, there could be a significant chunk of it which would have severe trouble in terms of its eventual completion because of the financial stress or the operating stress of the concerned developers.
Your point, one hopes the Amrapali template works out and then we can use that template for other projects as well. Mr. Tyagi, if you can, zoom out and look at the 1997-2002 downturn, which was there in stocks, in the economy and in real estate as well. I'll tell you a personal example. At the height of the boom in 94, there was an apartment in our building which sold for, at that time, 25 lakh. And at the absolute bottom in 2002, an apartment sold for 15 lakh. Now, where are we in the cycle? Do you think that on an average, there is still some distance for flat prices to decline in some parts of the country?
So again, Lata, one hears anecdotal pieces, and obviously in the 97 to 2002 period that you mentioned about, I was luckily not in the real estate sector. I was in the IT space, so was reasonably insulated from this. But in all fairness, what we have seen, at least in the Gurgaon and New Gurgaon spaces, is that the secondary market prices, which I've always maintained are a more secular indicator of where the market is, were declining, but I think the decline seems to have been arrested, I'd say, across the last 4 to 6 quarters. In fact, in the main Gurgaon, DLF 5 and these areas, actually the resale prices have begun going up again. Not necessarily in the New Gurgaon piece, because there is an overhang of finished inventory out there. I mean, theoretically speaking, it could be argued that there is some space for the prices to go down, but one is not, honestly, for the last at least 4 odd quarters, one is not seeing any downward movement in the secondary market also of prices going downwards. And so, I mean, could it be because of the financial struggles that the builders and the customers are facing? I'm not sure. But purely from a data standpoint, as the IPCs and people like Prop Equity will tell you, there doesn't appear to be a downward trend, at least in the Gurgaon market on the price front. So let's see how that pans out, frankly, going forward.
Just having this discussion, and an interesting point that Lata raised, are people preferring to buy completely finished flats now compared to an under construction project, just because there's an uncertainty with respect to financing of the project, completion, etc. Are you seeing higher sales in finished projects? Giving an individual example of ours, we are definitely seeing the finished projects, having a good traction. And frankly, at least again in the NCR segment, given the proportion of the unfinished inventory that there is, I think you can't blame the buyers if they today want to be assured that they are buying something which is actually finished, which they can move in for the next, within the next 4 to 6 months. So it's not just the bank financing piece, Sonia. It's also the fact that customers do not want to handle the uncertainty of going into a project which could take 2, 4, 6 years,
to complete, and unfortunately in some cases may never be completed also. So clearly there is a clear bias that we are seeing towards projects which are completed or which are in a very advanced stage of completion as compared to the old world, sale on just the brochure level, which used to be the norm 5-6 years back.
It's been a pleasure listening to you. Thank you very much, Mr. Tyagi, for joining us and giving us a view of both the DLF's own position and the industry. So it looks like, going by secondary market prices, as Mr. Tyagi points out, that maybe things have troughed out. And especially, of course, for those who have fixed their balance sheets and have healthier, robust balance sheets, maybe we can look at perhaps higher prices and higher sales at least. Let's wait and see. It's a positive conversation after quite some time.
Yes.
We take a break on that note. We are going to analyze the road ahead for investors in CG Power. Yesterday, we detailed to you the problems that were unearthed from the latest P&L and balance sheet. Amit Tandon of proxy advisory firm IIAS is joining in.